All right. See some comments coming there in the chat. We appreciate it. We'll get started here in just a moment. Keep dropping comments there in the chat. You can also drop any questions you have in the chat as we go through here today. And with that being said, it looks like we're live on all the different platforms, so we'll go ahead and get it started here. We'll take the chat off the screen for now, but keep dropping comments there and drop any questions you have in the chat as well. So welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and what we do every morning at 11 a.m. Eastern on this show is go through our actual live mortgage rates, and then we do a deep dive into a different loan topic. Today's topic is going to be short-term rental property loans, something we love doing at the Mortgage Calculator. And our sales manager, Jose Gonzalez, with 28 years of experience as both a loan officer and a realtor in South Florida, where there's a lot of short-term rental properties. He will be doing a breakdown for us into the short-term rental property loan options that we have and going over some actual pricing for today for those programs. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and see what the rates for the different programs are looking like today. So Nick, if you're ready, let's go ahead and pull up the pricing and let's see what the market is looking like this morning.
All right, switch my screen and we will check it out. So this is our pricing tool for our team here. This will show us the general rates and the APR for today. It is just after 11 a.m. Eastern on March 5th. So all of our standard programs are live. This will allow us to compare the APRs across the program. But if you'd like a full breakdown of all the itemized fees that go into the APR, please get with our team members. We have over 300 licensed loan officers. To compare the programs today, we'll set up a basic scenario to compare across. We'll set up a $400,000 loan amount, set the LTV to 80% loan, 20% down payment, and we'll ask the computer to find the lowest rates we can offer for conforming conventional, and then we'll compare that to FHA, which is usually the second option for most borrowers. And then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional options here. We also offer VA. That's only for our eligible vets and active service members. If you are, just let us know. We can quote it, no problem. We also have USDA. That's only for eligible properties. If you do happen to be looking in those areas, just let us know. We'll start with conforming conventional. We'll do purchase, 30-year fixed, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated credit score here of 760, an estimated debt-to-income ratio of 40%. So let's see what the rates are showing this morning. All right, about the same as it was yesterday here, 6.49 rate, 2.25 discount points and costs, puts the final APR at 6.765. And hopefully we see some more downward momentum this week as we did towards the end of last week. Now, if for any reason our customers don't qualify for conventional, usually the next option we want to quote and check out is an FHA program. So we'll set up the same exact scenario. Everything will stay exactly the same. All we're editing here is the loan type to FHA. Even though it does allow more leniency on credit events as well as a higher debt to income ratio, we'll keep everything identical so we can compare APRs across the programs. And as usual, FHA is a touch cheaper here than conventional. 5.75 rate, 2.125 discount points, puts the final APR at 6.662 there. For our customers that need to use the FHA programs, this is awesome because it's actually a touch cheaper in this case. And our customers that qualify for both, definitely check out both. Might be a touch cheaper. This APR does include the upfront and yearly mortgage insurance. So definitely a great option, almost identical to conventional there. Now, our customer does not qualify for FHA or conventional. Most other banks or lenders will have to deny that customer, but that's where we love to present our 5,000 additional options here under expanded guidelines. So when we select expanded guidelines, everything will stay the same, but now we have a new option where we can change the income. So if our customer doesn't qualify with full doc, which is what we use for FHA and conventional, that's 2 years of tax returns, we will take advantage of an alternative. We have asset related, business bank statements. The investor programs are just for investment properties. We'll show those shortly. Personal bank statement 12 month is what we use for the demo. We also have RSU, stated income, VOE, 1099, P&L, and no income CDFI. But the most common here is the 12-month personal bank statement, and that's for our self-employed borrowers. Many times when our self-employed borrowers have 2 years of tax returns, they may have various write-offs and may not qualify or just need a little bit more income. Either way, we can help them out. No tax returns at all, just their last 12 bank statements, and then we'll determine a debt-to-income ratio of 40% in our example here, using just their cash in the bank. So most of our self-employed borrowers qualify for much more income. So let's check out these options today. Awesome. And as I mentioned last week, it takes about a week for non-QM to adjust, and boom, we see a great option pop up here. Now at the top, 6.875. Awesome. 2.425 discount points and cost. Puts the final APR at 7.282. So pretty amazing option there, and it's within half a point of conventional, as we are roughly every morning here. And it's a great option for our customers that need to use those flexible options for bank statements. And if we scroll down, notice there's hundreds of variations. Some of these at a little bit higher rates and costs, may allow things like bankruptcies and foreclosures, and may allow slightly different ways to calculate the income. So those are our primary examples. Now let's go back and set up some investment property examples. So we love to work with investors, seasoned investors and first-time investors. We definitely have great options for both. We'll set up the same scenario, $400,000 loan amount, 80% loan, 20% down payment. And we'll have the computer find the lowest rates we can offer for conforming conventional, and then we'll compare that to expanded guidelines. Remember, government programs like FHA, VA, and USDA do not work for investments. So we'll start with conforming conventional here. Everything will stay identical as all our demos. We've only changed the occupancy. See what it's looking like this morning. And the gap is closing a little bit there. You see the portfolio option is the top. Remember, this is not a true conventional option. Same guidelines, but doesn't have the loan level price adjustments of the Fannie and Freddie programs. So this option, 6.875, 3.25 discount points of cost for a final APR of 7.264 is a great option for our investors that want to do full doc. The first true conventional option, just a little bit more expensive with those loan level price adjustments. 7% rate, 3.375 discount points, pushes the APR up to 7.406. So once this gap closes, you might see this portfolio program drop, as it is technically a non-QM program. So this will probably stay the same rate for a long time, while these do fluctuate every single day. But always keep an eyeball on that when it does become cheaper. Now, I definitely recommend all of our investors also check out our non-QM options. So for the final demo, we'll set back up the same exact scenario. And this time we'll select expanded guidelines, also known as non-QM. First thing we need to pick is our income type. The most popular income type for investment properties and our most popular loan type going to be the DSCR option, because it doesn't require any income or employment info from our borrower. Simply use the estimated rental income from the appraisal to determine a DSCR value. Stands for debt service coverage ratio. If the estimated rents can cover the expenses, aka the property cash flows, that's a ratio of 1 or higher. We have options for ratios under 1 as well, but for our demo we put 1.5 so we can see all the programs pop up. And finally, a prepayment penalty must be selected. That is standard on these programs, so 3 years is what is pretty standard here. That's what we use for the demo. There are options for no prepay. That does cost quite a bit more and limits the programs. And you can also select 5 years, which will limit the programs, but does save our borrowers some money that are holding long term. 3 years is the most common. That's what we always set up for our demo here. So let's check the DSCR rates today. Wow, even more smoking than yesterday. 6.625 rate, 3.4 discount points and cost, puts the final APR at 7.126. Absolutely smoking conventional, smoking the full doc portfolio. I would say 110% of investors that are presented with this DSCR option will take it. So definitely recommend all our investors check that out. And if we scroll down here, there's tons of variations. Some at a little bit higher rates and costs may allow things like bankruptcies, foreclosures, credit issues. Some may allow different ways to calculate the rental income. And some may allow different types of properties. Both of those last two topics are what we're talking about today. So, perfect segue here. Let me switch my screen. And today's topic is going to be Short-term rental property. So when we do the live quotes for DSCR, obviously a lot of the customers that are seeking those investor DSCR products do plan on short-term renting their properties that they're purchasing a lot of times, right? So a very popular request. Not all of those programs we do in the live pricer allow us to use short-term rental income to calculate the DSCR, but some do. So that's what Jose has picked out here today, is some of our options that do allow us to use that short-term rental income. It is a little bit tricky. It's program by program, right? Case by case. But Jose will explain in general terms how we can execute one of these. And then, of course, if you don't need the short-term rents to qualify for a DSCR, you don't have to worry about any of these items as well. So if long-term rents are solid, maybe don't go down this path. But if you do have to use short-term rents, there are a plethora of programs that do allow it. And Jose will present some of those options today. So, Jose, if you're ready, let's check out some of those options.
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. This is a topic that's very exciting to me. Like Nick mentioned, even though I do have a bunch of licenses all over the U.S., my real estate license is in Florida, and do have some exposure to putting together quite a few short-term rental projects in Florida. And that's the beautiful thing about the DSCR programs. And that is also the beautiful thing about when you go deep, do a deep dive into the guidelines of all the different DSCR programs out there, all the different options that we have, and realize how all the different opportunities that are available. Because, as we all like to state here at the Mortgage Calculator, not all non-QM guidelines are created equally, right? There's a bunch of them out there, and pretty much almost everyone has different tweaks to it that allow us to implement them in different scenarios. And our favorite scenario to take advantage of all the flexibility that the DSCR has to offer is short-term rental properties. Now, short-term rental properties, when it's a purchase, right, is where you really have even more flexibility than when it is a cash-out refi. Because when it is a purchase, you, the buyer/borrower, are not yet the owner, right? So what you're going to do with the property is what you're going to do with the property, and what the current owner is doing with the property is what they are doing with the property. Now, if you're buying a property that is currently being used as a short-term rental, that obviously gives you greater opportunities to use all the different guidelines, like with short-term rental revenue reports. For example, if you're purchasing a property, you're not going to be able to provide short-term rental revenue reports like from Airbnb, HomeAway, VRBO, unless the property is being used as a short-term rental, and those revenue reports are available. The same with bank statements showing the deposits. Same scenario. If the seller is using the property as a long-term rent, then that option is not available, but the AirDNA option is available. AirDNA being a database that has short-term rental comparables, and the appraisers and the underwriters would use it in the same manner that you would use the MLS, for example, the multiple listing for realtors, to look for long-term rents. In this case, you're going to look for short-term rental properties, and you're going to apply the same parameters, right? Proximity to the subject always is one of the most important. In other words, the closer to the subject, the better that comp is. The GLA, or gross living area, and the style of the property also has to be similar to the subject. Comps, you can't get like a brand new property and compare it to a 60-year-old property. Even if that other property has been updated, it's not going to be the same. Usually the newer properties have bigger closets, bigger kitchens, family rooms, all probably garages, and all these things that the older properties may not have. So again, you're going to look for the comps the same way you look for long-term rental comps. So the one thing you do have to worry about, well, when using AirDNA is that there is an LTV adjustment. There's a 5% LTV adjustment usually when using AirDNA. We do not have that restriction when using short-term rental revenue reports. So let me get into my examples here today. Awesome. So our first example here is using AirDNA. Now that's like the unicorn now in the DSCR world, right? You have that property that has some great AirDNA comps, and you as a user can have access to AirDNA, but usually underwriting will run their own AirDNA report as a quality control measure. So in this example, the pricing that you're going to see here is the pricing for 85% LTV. And then I adjusted the loan by 5%, reduced it by 5%, but it is the 85% DSCR pricing, which is an amazing option. So here we have 8.625 as our lowest cost option and 7.75% as our lowest rate option. And keep in mind, like I like to state in the beginning of all of these presentations, there are rates that are lower. However, you would have to pass the compliance test, your points and fees part of the compliance test. And if you get some bona fide discount points, then you could certainly go lower than 7.75. But we're showing here rates that are in compliance. So this is our AirDNA option, 80%. And by the way, this option is for 1-unit properties only, because the 85% LTV DSCR option for purchases is for 1-unit properties only. It is not applicable for 2 to 4-unit properties. Now, here is our option using short-term rental revenue reports, right? This is for when you're buying a property that the current owner is operating the property as a short-term rental. Now, you do see here, this is a 80% LTV option. No LTV adjustment is applicable when using revenue reports, because revenue reports are real numbers, right? It's real data. It's not a projected number like AirDNA. AirDNA projects what that property will do based on the parameters and the available comps. So in this case, 8.125 is our lowest rate option, almost at par. And you can buy that down all the way to 7.25%. Here, I'll go back over here a minute so you can quickly compare the differences, right? This one is 8.625 and it's costing 1 point more than our lowest cost option right here. So if you can use the revenue reports, that's awesome. And that's the structure advice that we as consultants have to provide to our borrowers, right? We're the licensee. We're the ones that know all this information. We're the ones that have our head in the guidelines all day long and should be able to share these nuances with our borrowers. That is where you differentiate yourself, by the way, as a consultant from the application takers. So now here is the 15% down. Again, this is the unicorn, but this is, remember, this is a purchase, and this option is for 1-unit properties when the long-term rent covers. In other words, you don't have to go in there if you're buying the property and say, hey, I'm going to use this as a short-term rental property, and I want to use short-term rents to qualify the property, and I want to use this. And if the long-term rents cover on a 1.2 to 1 basis, that's the key here, 1.2 to 1, meaning that the long-term rent covers the total housing expense by 120%, then you are good for this 15% option, the unicorn in the DSCR world. And you're looking at 8.75 as our lowest cost option and 7.875 as our lowest rate option at a 15% down, 85% LTV. So again, using only the long-term rents, short-term rents as a topic does not even come up, nor should it in the application, because you're purchasing the property, and if it qualifies under long-term rents at a 1.2 to 1 basis, that's it. And now a little bit more standard 20% down using long-term rents. So this is similar scenario as we just covered. If the long-term rents cover, that's it. No need for anything else. In this case, you're selecting this option for one of three reasons. Either A, you got a 2 to 4 unit property and the 15% down option doesn't work for you, or B, your DSCR is not on a 1.2 to 1 basis. And in other words, here it's on a 1 to 1 basis. And three, you want a lower rate, right? Doesn't hurt to have a lower rate, or 4, you need a lower rate to get that DSCR to be 1 to 1. So here you go. 8.375% lowest cost option is actually giving a lender credit. We love when we get those lender credits. And you can buy that down all the way to 7.125%. Amazing option here for a 1 to 4 unit purchase. No loan level price adjustments either for 2 to 4 units. So 1 to 4 unit, same pricing, 20% down long-term rents. Now, here's some of the mind blowers I love to throw in here. Now, this is where we have our short-term rental property, but for whatever reason, the long-term rents or the revenue reports, if that's the best case scenario for income, because remember, we can use both long-term and revenue reports, where our DSCR, in other words, where our debt service coverage ratio, because that's actually what DSCR stands for, is between 0.75 and 0.99. That means we don't cover 100%, no matter if we're using short-term rental revenue reports or long-term rents. So whichever is the option that best works for us puts us between a 0.75 and a 0.99 for 1 to 4 units. We can go up to 75% loan to value for this property. This is also where AirDNA comps are not available. So in this case, keeping in mind we're below 1 on the debt service coverage ratio, we're not even covering the housing expense, but we can still finance that property for you at the mortgage calculator with 25% down, and 9.125 is our lowest cost option with a lender credit. Again, we love those lender credits, and you can buy that down all the way to 8%. So just think about this. We are not covering 100% of the housing expense. We can still finance it for you with 25% down, 30-year fully amortizing loan. This is not hard money. This is not a short-term loan, and you can get 8%. How you like them apples? Now, if that one wasn't good enough for you, then this one definitely will do it for you. This is our no ratio option. Same concept. Your AirDNA comps, there are none available, and either the long-term rent or short-term rental revenue reports, if available, do not cover at least 75% of the housing expense. In other words, theoretically, it could be 0 on the DSCR, and this option would still apply, even though I doubt you would ever have a 0, because every property is going to be able to rent for something, right? This is a max 75% for this option. And look at the rates. Remember, this is, DSCR could be 0 and you're still 10.125%, again, with a lender credit. And we can buy that down all the way to 8.75%. Just put just wrap your mind around that. You are not covering even 75% of the housing expense. You could be at 30%. You could be at 20%. You could be at 10%. And you could still get 8.75%, 30-year fully amortizing full-term loan. Now, this is my last three options will be refinance options. So here is 75% LTV using long-term rent or revenue reports where your DSCR is at least covering your housing expense is being covered on at least a one-to-one basis. Now, keep in mind that you're probably wondering, yeah, but what about AirDNA? Why don't you use AirDNA? Well, simply because AirDNA is for purchases only. If you are doing a refinance, it's going to be either long-term rents, revenue reports, or bank statements showing the short-term rental revenue deposits. That's the only thing that's going to be acceptable when you're doing a cash out or rate and term refinance. But remember, 75%, but look at those rates. Now totally smoking here, right? 7.875 with a lender credit. Remember, this is DSCR we're talking about here, not full doc. And this is for 1 to 4 unit properties as well. No loan level price adjustments there. And you can buy it down all the way to 6.75%. Wow, that's pretty amazing there. Now, this is our low ratio. Again, the 0.75 to 0.99 DSCR option using either long-term rents or revenue reports. Maximum 70% LTV. So they do give a 5% LTV reduction when going from the purchase to the cash out refi. 9% gives us a little bit of a lender credit there, and you can buy that down all the way to 7.875% for our low ratio DSCR option, where you are at a 0.75 to 0.99 DSCR. And then for our last option, I have to leave this option for last because usually most people's minds blow on this one, and then they're at a commission for a few minutes while they gather themselves. But this is no ratio. You are DSCRing less than 0.75. You're basically from a 0 to a 0.74 DSCR. 70% maximum LTV again for this cash out refinance option. 30-year fully amortizing loan, not hard money. 9.5% with a lender credit. Again, we love those lender credits. And you can buy this one down all the way to an unbelievable 8.25% rate for your no ratio DSCR 70% max LTV option. So I covered quite a few options. I covered the whole continuum of options for you here on purchases and cash out refinances for your short-term rental property. Short-term rentals are definitely all the rage out there in the industry besides investment properties in general. And here at the Mortgage Calculator, we are locked and loaded, ready to serve and make your objective a reality.
Looks like we do have a question here. Let's see. Go pull it up there on the screen. The question is, for a rural area, how many miles away can a comp be in order to be used?
Usually 3 miles. Now, again, you would have to read the guidelines because I'm generalizing here in my answer because it is guideline specific. Every single DSCR loan, like I mentioned, you got to look at the guidelines that you're using to place the loan, the conduit you're using, and look to see what that guideline says. But it's usually 3 miles. Now, a couple other factors to consider in rural. Now, we do have our options that some do accept rural, others say absolutely not rural. And the ones that do say rural are going to have some caveats to it, like the comps can't be more than 3 miles apart. You can't have a dirt road in front of the subject. And I think there's a couple other ones, like how far the conveniences like shopping and the schools and stuff like that are away from the property. But those are usually like 25 miles or something like that. So those are not usually going to hurt you as much as the comps. If you have, 5 comps and only one is 3 miles away and the other one's is 8 miles, 9 miles, 11 miles, 15 miles, then you're going to have an issue. So keep that in mind. But that's a great question, Jackie.
Okay. Looks like that's the only question we have. Great programs there. We love to do these at the Mortgage Calculator. So thanks for going through those for us, Jose. Appreciate everybody tuning in. Remember, we do this 11 a.m. Eastern every weekday where we go through the live mortgage rates and then do a deep dive into a different topic. So we'll be back here tomorrow with a new topic. We appreciate everybody tuning in. We'll see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Have a great day, everybody.